Hello, everybody. So, Lovesac has reported earnings this morning, and I wanted to share my final thoughts on this company and my final decision. As a reminder, Lovesac is a maker of modern furniture. They are focusing on the couch and chair segment, and they make this kind of a designer's dream right there, which is a couch that you can use your whole life and that follows you your whole life. And so let me just go briefly through the earnings. So in the last video 2 days ago, I said I was looking at the stock because analysts expected 30% revenue growth going forward. And one of the wonders that I had is that going to hold? And another point of concern that I had before buying the stock or even thinking about buying this stock was the fact that they had kind of a seasonal business where Q4 historically had been a very, very strong business for them. And so the question was, are they going to have an outstanding Q4? Did they just have an outstanding Q4? And so the stock is up, I think, 13% compared to yesterday. Because yes, in a nutshell, they did have an outstanding Q4. They had a great Q4 with general profitability and cash flow trajectory very positive. And so the stock was up because the market is very, very backwards looking, and the market sees that they just did really well. So let's buy the stock. That's kind of the market thinks. I believe the market right now is not thinking 12 months out, etc. And that's where I got my red flag, because they gave an outlook, and that outlook, if I am generous, that outlook that they gave, if I assume the higher range of the outlook, that would be a 13.5% forward revenue growth. And so to me, that is a sign that this stock, is going to go for a clear slowdown. They're probably strongly linked to the housing sector. And so 13.5% revenue growth, right? As you know, most of the stocks, maybe 95% of the stocks on the channel that I follow have at least 30% forward revenue growth as guided by management. So this obviously does not fit this criteria. It's not good enough for me. It's too low for me. But I just want to say, in absolute terms, like if you think about it in absolute terms, that's much better than the S&P 500. So if you're a value investor, you're going to love this. If you're a hyper growth investor like I am, you're going to find this is a pass, mostly, despite all of the good things that the product has. Right? The product has a lot going for it. So now that I've gone through the bad, which was really that revenue growth, let me go through the good. They had a lot of good, right? They ended Q4 with $43.5 million of cash, up from $3 million in Q3. So this is a confirmation that this is a seasonal business. Their Q4 is always an outstanding Q4 whenever you look at their quarter. They do great sales during the holidays. The inventory was way down, so they managed this pretty well. They dropped the inventory from $155 million to $120 million of inventory. That's a clear green flag. Line of credit still untouched from Wells Fargo. That's a green flag again. Marketing spend is down as a share of revenue. That's a big positive. SG&A increase, so you probably know my thoughts about this, but let me read this. SG&A increase was mostly due to a replacement of stock-based compensation by cash bonuses. And if you follow the channel, you probably know how I feel about that. I much prefer SBC. SBC does not take out cash of the business. When I see of a business like Lovesac, they have more than $150 million in debt. I don't understand why they would not want to give SBC as part of their compensation. It's much safer for a company that gets so close to so low on cash, right? $3 million on cash in Q3. To me, I would feel better with the anti-fragility of knowing that a lot of management and a lot of higher level management in there gets paid in stock-based compensation and not necessarily with cold hard cash, which is so important. Gross margin was down, but barely, nothing to be concerned about. It's about freight. Freight went up, and then I guess in some seasons freights will go down. It doesn't really change too much for me here. I consider it flat. I consider gross margin to be flat. And the marketing strategy is doing well. They're moving ahead, full steam ahead. I mean, it's only green flags in marketing strategy. They have more sales channels, more showrooms, kiosks, stores. They just got into Best Buy, for example. They have a shop in shops where they set up a shop in another shop. That's what they have at Best Buy. They have a Costco rollout. So the marketing, again, doing really great. So lots of good things going for it aside from that growth. This is what doesn't get me excited. Guiding 13% in the best case scenario, that does not get me excited. So again, for something that's not my style of investing, but if you're looking for like a deep value stock, I believe this is an interesting play, an interesting value play. In fact, if you look at their adjusted EBITDA, they're guiding about 60 million, right? Which is pretty high. Although let's be careful with a company that's like a Lovesac. Let's be careful to not confuse EBITDA with cash flow with them, because they have $150 million in debt and they actually pay taxes. They are showing net income. They have net income, and understandably, this is a pretty simple business. They don't have to reinvest a lot in R&D. Marketing is the main operating expense that they have, right? So net income is going to be in the range of 30 to 36 million. That's what they guided over the next 12 months, which would be up to $2.24 per share of net income on a forward 12-month basis. Current P ratio, despite the run-up, the run-up today was about 13%. Despite that run-up, current P ratio is a 13, and it's a 12 on a forward basis, a P ratio of 12. So again, very inexpensive stock, a good value stock, but does not fit my style of investing. And sometimes not buying a stock that you find interesting requires as much confidence and it requires as much restraint sometimes it's all about being disciplined, right? Like, even if you like a stock, you gotta be consistent with yourself. I like this stock, does not fit my criteria, I'm not buying it, but I would not blame anybody for buying it. It seems like an interesting play. Could also be a good bet on housing recovery. So that's all I have to say about Lovesac. Not investment advice, of course, just entertainment. Thanks for liking and thanks for subscribing. I appreciate all of your comments and likes. Thank you and have a great day.